What's up, guys? It's About47, and welcome back to another YouTube video. It's a beautiful morning here in Costa Rica. We got our coffee, we got our computers open, we got the charts running, ready to get to work. In the last video, we talked a little bit about individual candles and how you can get information from them, be it the wicks or be it the bodies. In today's video, I'd like to talk a little bit more about the language that these candles use to communicate, which is also known as market structure, and how this can help us essentially understand the market just a little bit better. All right, guys, now that we have a view of the chart, I'd like to break down three main states that the market can be in that we need to be able to identify. We can classify these as uptrend, downtrend, and consolidation. In order for an uptrend to be considered accurate, we need two things. We need price to make consecutive higher highs followed by higher lows. In this instance, you can clearly see how the market is making higher highs followed by higher lows. Now, one important thing to keep in mind when classifying and watching for uptrends, when the pullback happens after the initial upward move, we can have that go as far as 9/10 or almost 100% of that original move. It cannot pass that original level that it was at before that move happened. Let's take a look at a downtrend right now, which again, we see a clear example of price making lower lows. This is what we want to see in a downtrend. Now, the third state that the market can be in, other than an uptrend and a downtrend, is in consolidation. Now, let's look at what that might look like. As you see here, we have a market that isn't really making higher highs or higher lows. Essentially, it's just staying within a very small range. Usually during consolidation periods, we are not taking trades. Neither buyers or sellers are overpowering each other. So this right here alone can help you filter out, trades that aren't going to make you money. You sort of have to know your way around the first three in order to move to this next thing we were talking about, which is called breaks of structure or changes of character. Essentially, what does that mean? It means that if the market was in an uptrend, that uptrend is going to be broken. What do we need for that? Well, an uptrend needs consecutive higher highs and higher lows. The second the market fails to make another higher high or a higher low, then what we'd be looking out for is a change of character or a break of structure. We can clearly see the market here is in an uptrend with higher highs and higher lows, this being the most recent highest high. What happened? The market came down and it started consolidating in this range right here. It wasn't making neither higher highs or higher lows. When the market tried to retrace and make another higher high, it failed to do so. Drawing this horizontal line over, you can actually almost see that it reached the exact same price it did before and it failed to make new highs. After failing to make a new high, it proceeded to make a lower low. This right here is one of the components that we need for a downtrend. So you start seeing it favor more downtrend than uptrend. If you follow that lower low by a higher low, followed by another lower low, we have now switched from being in an uptrend to a downtrend. This is something that you guys need to be comfortable doing and have some sort of, how would I say this? You need to be able to identify this correctly if you want to maximize your place in the market. Now, with these four things talked about, we have uptrends, we have downtrends, we have consolidation zones, and we have changes of character or breaks of structure. This is the most base information that you guys need to know if you want to get your foot in the door when it comes to markets. Once you have these four ideas sort of understood, we can move on to what are trend lines. You might be asking, what are trend lines? Essentially, they're really only visual guides that we as humans use to help interpret the market and figure out what it might do in the future. What makes up a trend line? Well, a trend line can be made either on top of the market or below it or in between it. Again, like I said, it's really only a visual aid for us humans. There is nothing on the chart that actually backs trend lines. For example, we have all of these higher highs being made here, marked by these arrows. On the underside of that, just analyzing a bit, you can see that the market is actually making higher lows. What is this telling us? The market is clearly in an uptrend. Now, when it comes to trend lines, all a trend line is connecting three or more points where the market has touched, be it the highest highs or the lowest lows. That is what you're using to identify potential trend lines. As you see here, connecting all of these points with a trend line can help mark out where price might go in the future. And you might have also noticed that not all points are going to touch the trend line. This is because this is really only to help our brains. If we run a trend line on the underside of this move, where the lowest lows are, you can also see that it sort of lines up and touches multiple zones of the chart. What you guys are seeing right now is actually called a channel. This is one of the many things that you can use to identify where to take trades, paired along with other things such as support and resistance, which we're going to talk about here in a little bit. But nonetheless, it's something useful to know about. Now, moving on to identifying support and resistance. What is support and resistance? Essentially, you can think about it as market memory. It's a zone where the market remembers it reacted to in the past in a certain way. How do we look for support and resistance zones? Well, we'd be looking at areas where the price has fluctuated or tends to go a lot. How do we find these areas? It's actually really simple. If we head over to the drawings tool and we find the horizontal ray and click on any tip or part where the market failed to make a higher high and extend that line over, price in the future tends to retrace and hit that line very accurately. For example, we're just going to add a couple horizontal rays at zones where I see the market has just either stopped or had some sort of trouble. As you guys see here, it almost looks like a bunch of random lines. But if you take a look closer, this peak right here, although it seems like nothing, if we go over to the right at a future price movement, you can see that price somehow retraced and tested that area exactly. We can also take another line, for example, let's call it this one. We can see how price came down, rejected this area, continued doing whatever it wanted to do. Now the line is already marked out. If we look at a future time in the market, it came back, retraced to that line exactly, and used it as a support level before its next move. Now, pairing what we've learned today, identifying the different states a market can be in, if it's in an uptrend, if it's in a downtrend, if it's consolidating, when the market might break that structure, and pairing that with trend lines in areas of support and resistance can massively help your entries and start to make the market feel a little more understandable. Now it sort of seems like the moves are calculated and there's a reason behind them instead of sort of just randomly guessing and essentially gambling. I hope you guys enjoyed today's video. When it comes to what we were talking about today, the more you understand and learn the language that these candles use to communicate, the easier it's going to get to read the market. Anyways, I'll see you guys in the next one.